Good evening and welcome to our financial report. Let's start with a recap of last night's U.S. stock market. The three major indices closed essentially flat, with gains and losses near 0%, sending a very weak directional signal. The Nasdaq finished at 25,678.82, the S&P 500 at 7,386.65, and the Dow Jones at 50,872.11. However, pre-market futures were slightly lower, with Nasdaq futures down 0.19%, S&P futures down 0.17%, and Dow futures down 0.37%, suggesting that today's opening may face some pressure. On the individual stock level, movements were relatively moderate. Nvidia closed up 0.85% at $208.19, Tesla rose 0.2%, QQQ gained 0.16%, and SPY added 0.18%. There were no verified significant outlier stocks yesterday, with no single stock moving more than 8% in either direction over 24 hours. What deserves your attention is the VIX, the fear index, which surged from 18 to 20.96 in 24 hours, a jump of 16.44%. This unusual move has not yet been linked to any verified triggering event, but the absolute level of the VIX has moved from the lower end of the normal range of 15 to 25 to the upper middle part. This rise in implied volatility could weigh on risk assets, so investors should stay alert. Now let's look at the key global macro indicators. The 10-year U.S. Treasury yield is at 4.528%, down slightly by 0.18%. It is trading in a narrow range around 4.52% and has not broken through the recent high of 4.55%. There is no further tightening signal from the liquidity side, but the elevated level still puts implicit pressure on growth stock valuations. The VIX, as I just mentioned, is in the cautious zone. Its single-day surge of over 16% without a verified trigger suggests that the market's pricing of uncertainty is rising on its own, and sentiment has shifted from calm to watchful. The U.S. dollar index is at 99.92, up a marginal 0.02%, still consolidating weakly below the 100 mark. A weak dollar is a short-term positive for emerging market assets including A-shares, but if it breaks below the previous low of 99.7, it could trigger a short covering rally in the dollar as a safe haven. In the commodity space, WTI crude oil is at $89.42 a barrel, up 1.54% over 24 hours. Oil rebounded on supply-side news but remains below $90, reflecting cautious demand expectations. Spot gold is at $4,177.70, down 0.82%. This is a key signal. Gold is giving back gains without any major event, and while the VIX is spiking, gold is falling. This tells us that it is not flowing into traditional safe havens. The market structure looks more like the early stages of a liquidity panic rather than a geopolitical move. Investors should be alert to the possibility of a chain reaction that could lead to a sell-off in risk assets. To summarize the global market environment, we are in a risk-off mode. The core evidence is the VIX surging 16% in a single day while gold is falling. Money is not flowing into safe havens. Instead, it may be a broad deleveraging driven by liquidity or position squeezing. If the VIX falls back below 19 and the 10-year yield breaks below 4.45%, market sentiment could recover and shift to neutral and range-bound. On the RMB front, the onshore and offshore rates are almost identical, around 6.77 to 6.78, with very little intraday movement. The impact on foreign capital flows into A-shares is neutral. Regarding U.S.-China tariffs, trade, and tech friction, no new verified events have been reported. Turning to the A-share market, we have already seen clear divergence after today's open. The Shanghai Composite is down 0.42%, the Shenzhen Component is down 2.06%, and the Chinext is down 2.7%. However, the Shanghai 50 index is bucking the trend, up 0.27%. This shows that funds are moving toward large-cap, defensive stocks. The opening sentiment is weak, consistent with the overseas market atmosphere. If northbound capital turns to net buying in the afternoon and the Chinex stops falling, sentiment could improve. For today's market, our judgment is that the Shanghai Composite will likely maintain a weak and range-bound trend, while the Chinex may continue to decline. The macro environment with the VIX spike is suppressing risk appetite, and the divergence we saw at the open suggests that structural adjustment is not over. If the Shanghai Composite can reclaim the 4,000-point level in the afternoon, and the Chinex decline narrows to within 1%, the outlook could shift to neutral. In terms of sectors, the most active today are likely to be utilities and consumer staples, as defensive positioning dominates. The Shanghai 50 strength confirms that capital is moving toward low valuation, high dividend blue chips. When the VIX becomes more volatile, defensive assets are the usual safe haven. For self-selected holdings, we suggest continuing to hold positions in high-voltage transformers and in-P substrate-related stocks. These are tied to AI infrastructure bottlenecks and have shown steady performance. They can be tracked as structural opportunities, but chasing highs is not recommended. As for risks, small and mid-cap tech stocks, especially AI concepts and semiconductor equipment, need to be avoided today. The declines in the Chinex and Shenzhen component clearly show that tech sector chips are loosening. Individual stocks like POET and AKTS have been flagged as recommended for cutting positions. They have high short interest and are vulnerable to short sellers in a corrective market. Northbound capital outflows are more likely today. A weak dollar is generally positive for emerging markets, but a VIX spike is usually accompanied by global capital retreating back to the dollar. Here is our core judgment for today. With the VIX unexpectedly surging and tech heavyweights under pressure, the A-share market has entered a defensive and corrective mode. Dividend-paying blue chips will likely outperform in the short term. Our probability assessment for today is as follows. A rally has a 15% chance. A range-bound session has a 40% chance. A decline has a 45% chance. Please stay cautious and manage your positions carefully.